Coming up today, stocks have their biggest fall of the year on the back of weak consumer sentiment. We'll take a look at the data, trouble brewing in Japan, the largest crypto hack ever, and what else is spooking the market today. You don't want to miss this one, guys. Let's go. And welcome back, everybody. Wasn't that a bit of a rough finish for the week here on this shortened trading week? Looks like option dealers got it wrong yesterday, and we were indeed in for a spicy Friday. It's the worst day of the year for the market, and our portfolios are taking a bit of a haircut today. However, this is all part of the investing journey, the inevitable bumps in the road and volatility that we're paid to induce. So stick with me today because we'll look at what happened, what caused it, and whether this sell-off is justified, and whether we could have further to go. And there was a clear rotation today, which I'll show you in a bit. However, looking at growth, risk on assets, there was selling across the board. We've now got the Russell 2000 down about 11% from its highs. So congrats if your portfolio is doing better than that, as this is the most broad representative index of the US stock market. Now trading below the lows of the day before the election into technical oversold territory. And it's funny because this is a pattern we've been seeing in a lot of Fridays this year. In fact, the annualized returns for Fridays this year is negative 86%. Monday's not all that much better as well, and it's typically midweek. We're seeing the market bump up. And this has actually been going on for a few months, ever since the 5th of August, that big monster Monday gap down. We've had a few others as well, the 3rd of Feb, 13th of Jan, and some other smaller ones in between. But the markets are obviously nervous going into the weekends, probably because of headline risk. We're just getting so many headlines thrown at us with this new administration. It's not really surprising to see the market a little uncertain, got a lot to digest, and it's not also unusual to see some weakness in the second half of February. Looking back in history, it can be a month that quite often consolidates, especially in the second half of the month. And just as we saw yesterday, there was already a bit of a clear sign of a defensive rotation, and we can see that again today. It wasn't a complete broad bearish sell-off of a day. It was really in the high growth risk on assets and other consumer related stocks. However, looking at the staples, utilities, and healthcare, a lot of them actually traded up today. So that's a rotation. That's a good sign. It wasn't completely red all across the board. And so apparently what spooked the market was this low consumer sentiment reading on growing worries over the outlook for the consumer, with confidence dropping and consumers' expectations for inflation rising. Even though we've seen actual prices in the economy drop over the last couple of months, I think this drop in consumer sentiment and expectations is from a few things. A lot of them are getting bombarded with negative headlines in the media about tariffs and big price hikes coming for their products, or at least just the uncertainty surrounding that. Also, I think there's still a bit of a credit card hangover from that bumper holiday spending period we had. Then, of course, we had that softer than expected guidance from the biggest retailer yesterday, Walmart. Their stock continuing to fall today. But like I said, I think that's more to do with hot air coming out of that stock. Valuation got to historical extremes. Stock price had doubled in the last year alone. But just getting away from the headlines and all the rhetoric and narratives out there and just looking at the hard data. Yeah, the UMISH consumer sentiment survey that came in was weak looking back over the last year. However, just zooming out to a 3-year chart, we can still see it's in an uptrend. And in fact, we had a lower reading in November 2023 and pretty weak there in the middle of 2022 as well. And just going out to a 5-year chart, kind of looks like inflation. It's come off a bit, but it's just kind of bumping around, basing around. But it's not like it completely fell off a cliff here. But again, you got to remember that's a survey of how people are feeling. It's what they're saying. Just looking at what they're doing. Real consumer spending, accounting for inflation, is still up there in some of the highest we've seen the last 3 years. Same with personal income holding up, and year-over-year growth in retail sales, still above inflation as well. The last print we got 4.2%. We also just had services PMI come in, and that too was a touch soft. However, still above lows we've seen in this bull market. But again, no doubt reason for the market to worry. However, the consumer is still in pretty good shape considering we've just had a couple of years of high rates. And now that rates have actually peaked, some of that pressure might be getting relieved. Because just looking at every income group of consumers, they have significantly less debt relative to history. When looking at liabilities as a percent of assets, that middle range sitting around 17-18%, still well below what we saw in 2008. But no doubt what else was spooking the market today? We're just getting reports that there's a new coronavirus discovered in China. And isn't that funny on the 5th year anniversary of the same thing happening this time in 2020? Hopefully they've got a hold of it this time. They have put in place much better systems and processes to properly address it. They've learned a lot from 2020. It's not good for them or anyone if we see all this happen again. So no doubt the market will be watching this closely. And it already appears we may be having signs of the market pricing something in here. Some of the vaccine stocks rising there today. Pfizer, Merck, Moderna up over 5%. And not liking that news, airline stocks Jets off almost 4%. Funny enough, Chinese stocks, one of the only country funds to rise today, along with Barber again, up another 5% after its good earnings yesterday. Just looking underneath the hood of the market, my market risk on off indicator, still in green here. As we can see, we've got quite a bit of red up the front across markets. A lot of them now below their 20-day moving averages. However, most of them still above their 50-day and 200-day long-term moving averages. My S&P 500 oscillator, still not quite into oversold territory actually. So no doubt this dip could have further to go next week before finding a bottom. I wasn't really looking to buy the dip on this move today. We might get another monster gap down on Monday. Then we'll take a look then. However, market breadth isn't all that bad. It's still holding up somewhat. Still got more than half of all stocks above their 50-day average. Pretty healthy 58% above their long-term 200-day average. And just looking at stocks making new highs, didn't actually fall off a cliff here today. Still actually well above lows from the start of the year when breadth was really waning. Same deal on the Nasdaq as well. 66 new highs, and just looking at lows, stocks breaking down to new lows, that's still below those peaks we saw earlier this year on both the NYSE and the Nasdaq as well. So that's a pretty good sign for the here and now. Things are not completely fallen off a cliff, but no doubt a pullback in growth stocks today. Just looking at the spread of the Vanguard Growth ETF versus the Vanguard Value ETF. And we'll just zoom out to a monthly chart here so we can really take a look at the trend. We're still technically in a growth-led bull market. We'd have to really take out these lows around here for us to start arguing otherwise. Otherwise, growth stocks are still close to all-time highs relative to value. And just looking at the volatility term structure, like I said, option dealers are mostly right most of the time. However, they got it wrong yesterday. We did get a big move today. But looking at the term structure, still in contango. Did flatten a bit with up the front bumping up, but we're still higher at the back, and the VIX front month futures contract still below the second month. Looking back in history, every significant correction or crash in the market, the VIX front month future will have already been above the second month before we get that capitulation in the market. So that could happen next week. However, as it stands right now, pretty good considering the price action we got going into the close here. Like I said, I think the market at this particular point of time, Q1 2025, is nervous to carry risk over the weekend. Headline risk, we're getting so many. Not to mention we've got PC inflation coming next week and NVIDIA's earnings. Some uncertainty going into that, however, that could set up to buy the dip if PCE comes in better than expected. Same with NVIDIA, we could see that Tuesday turnaround. Market starts sniffing it out before we actually get PCE and NVIDIA's numbers. Otherwise, just looking through price action across other key markets. High yield bonds, pretty much was an average day there, nothing out of the ordinary. Just down a touch on regular volume. And today was OPEX, third Friday of the month when regular monthly options expire. Not unusual to get these spicy Fridays. But again, high yield bonds holding up pretty good. Maybe a little bit of a flight to safety in treasuries. Not so much in the dollar though. But like I said, there's just a lot of uncertainty out there. Government's still in the process of working out what tariffs are going to be on what country. What are they going to do back, and how could that affect the prices of goods in the US economy? But interesting to note, inflation expectations actually came down today. Looking at the tip spread, the 2-year also came down, 4.19, which I think this coming off a little bit is actually a good thing for the market, along with crude as well. Bit of a fall there, almost 3%, $70 a barrel. That should help relieve any weakness in consumer spending. And once again, interest rate traders flicking back and forth when they think the Fed's going to cut again. This time dialing it in to May. And for the first time in a while, pricing in a second cut in October. And so if GDP holds up, along with corporate earnings, and we are able to get another cut or two in the cost of capital, that's a good thing for the stock market. And in fact, the market may be indeed goosing the Fed again into cutting for its own benefit, just like it did a pretty good job of in September and October last year, induced that big 50 basis point cut. Well, things were still bumping along just fine, along with more looks at the consumer as we get through to the back of Q4 earnings. Home Depot, Lowe's, a few others in there we'll look at next week, but of course the big one after close Wednesday, NVIDIA. And we'll get to hear from the man of the hour, Jensen Huang, CEO, who just said investors got it wrong on the DeepSeek sell-off. He said DeepSeek's innovations energized the AI world, but investors overlooked a key point. AI's growing reliance on post-training methods, which still demand NVIDIA's computing power. That's what we've been arguing as well. If more can be done with less GPUs, just like any other technology, the cheaper it gets, the more it gets used. Think about televisions. At first, only the wealthy could afford them. Then we got the scales of economy. Prices came down. In under a decade, just about everyone could afford one. Whilst the companies that made them got bigger and bigger. However, there is a bit of FUD out there today. Not surprising to see NVIDIA off 4%. Street expecting them to come in with 84.5 cents and earnings per share. I wouldn't be surprised if that's closer to $1 with good guidance as well. Jensen Huang knows there's a few clouds hanging over the stock now, which I think he'll do a good job in quelling. Probably also adding into uncertainty there today as well was inflation in the world's third largest economy, Japan, climbing to a 2-year high of 4%. This has been a worry over there for a little while now as they come off rock bottom lows in their interest rates, still grappling with embedded inflation. Country really can't afford high rates, got over 200% debt to GDP, and the market has been pricing that in for a little while now. Looking at JGB JGBs, Japanese government bonds, have been steadily climbing here, along with the dollar yen having a bit of a slide this week as well. And that weakness in the dollar and a few fears out there in the market today didn't really get gold breaking out, kind of just traded flat here. Did see Bitcoin come off a little bit, not too much, considering the move down in high growth tech stocks, and actually holding up pretty well considering the headline we just got coming out of the crypto world today. The largest hack ever, popular exchange Bybit, 1.4 billion just emptied out of the exchange earlier today after they've been hacked. And that was from the Ether cold wallet. I thought cold wallets were supposed to be the safest way possible to store coins. Bybit did say they're still solvent and that they should be able to cover the loss for clients. Last year in total, the crypto industry saw over 2.2 billion in funds stolen. That was reported. A lot of personal theft goes unreported. A lot of people are individually targeted when the online world knows someone's got a lot of coins. That was an increase of 21% year over year. And this has been going on ever since the industry was created. One of the largest hacks, I think, was back in 2010 or 2011, Mt. Gox. And this comes on the news that MicroStrategy, now just called Strategy, really innovative name they got there now, still doing their nifty little infinite money hack, raising another $2 billion in zero coupon convertible bonds as they continue their quest to corner the Bitcoin market. However, if you thought Bitcoin itself is an inherently leveraged asset, MicroStrategy just takes it to a new level. Bitcoin's still consolidating, down just about 10% from its all-time highs. MicroStrategy in the same period, down about 44%. What happens to this stock? Not if, but when Bitcoin has its next 70, 80, 90% bear market. Good luck to all the bag holders in this stock. I think it's going to be one of the biggest unwinds that we've ever seen. One for the history books. And it's kind of funny, isn't it? This crypto hack. Never a good thing when 1.5 billion goes missing. Someone or some group just got extremely rich today. Something you never see happen in stocks that trade on a regulated exchange with licensed brokers, many forms of security and insurances. I think a lot of people don't realize the inherent risks built into crypto and why there should be a huge risk premium, and why now Wall Street is the biggest custodian of crypto. Just BlackRock alone, their Bitcoin fund, has $56 billion assets under management. So Wall Street will do extremely well regardless of where the price goes. They get their annual management fees. And it's just kind of funny how Wall Street is now the biggest custodian of what was originally intended to be a decentralized currency designed to be held away from the system is anything but now. And can you just imagine what would happen if one of these Wall Street custodians' wallets got hacked? Even if they did have insurances and reimbursements in place, just imagine that headline and the negative sentiment it would spread throughout the industry. Because if these biggest exchanges, run by some of the smartest people in the industry, if their cold wallets are getting hacked, I don't think anyone's really safe. But anyway, regardless of all that, it's still a good proxy for liquidity and risk on sentiment in the markets. Just like ARK Innovation, down almost 6% today. Also getting knocked hard today, Hims and Hers Health, causing quite a bit of volatility in our stock picks portfolio. Down 25% ahead of earnings on Monday. But like I was saying yesterday, even if earnings comes in good, I wouldn't be surprised to see a big pullback just because it's just gotten so hot. Keep in mind today's trading didn't even take out the lows from last Thursday. Stock started the year at $24 a share, still up more than double. But it was on some news of Novo Nordisk announcing a resolution to its weight loss drug shortages, raising investor concerns about Hims' market position. But we've seen this news plenty of times before. And so again, as I always remind my members, you can't expect to have big upside without tolerating a little downside as well. Volatility is the price we pay for performance. There is simply no reward without risk. Moving on to another stock, Palantir, actually held up pretty well considering how volatile it's been of late, and the mood in markets today for high growth stocks, just off 4.6%, was a pretty good result. Others like Tesla, down 4.6%. Like I thought, we may come back down and take out those lows. Wasn't a really convincing looking bottom there. And we may indeed see a two handle before this puts in a bottom. A little bit of a pullback in Intel as well after its monster rip. And AMD coming back down, might test those lows. And Meta, which had been the best performing mega cap tech, having a bit of a pullback here as well. And just looking at the MAGS ETF on mega cap tech, currently sitting at a bit of support here, which may get tested on Monday morning. And one chart that may help explain the explosive move we've seen in Chinese stocks the past few weeks is also explosive move in their M1 money supply. And that's basically immediate liquidity in the economy, savings, deposits, and just going out to a 10-year chart, we can just see that huge move up thanks to record new loans on the back of policy stimulus. After we just saw last weekend, CCP leaders meet with all their tech heavyweights. New bank loans in China surged more than expected to a record high in January as the central bank moved to shore up patchy economic recovery, reinforcing expectations for more stimulus in coming months as US tariffs threaten to pile more pressure on the economy. Just as we'd been forecasting, they're going to fight back on those tariffs with record stimulus. And so that looks to have outweighed the threat of tariff so far. However, we can see FXI pushing up on a resistance zone here from that previous peak on the 1st first talk of stimulus in September last year. Little stretched here in the short term, wouldn't be surprised to see Chinese securities pull back, consolidate over the coming weeks. But all that attention and activity and trading should be good for Chinese related brokers like Tiger Brokers. Price just stalling out this week as well. And finally today, the latest video from another humanoid developer, 1X, who could also be a potential leader in this nascent field. With their Neo Gamma, another humanoid at home, they can do stuff for you. Bring you a coffee, fix paintings, do your laundry, vacuum your floor, even clean your windows for you, help you with your groceries. And here's a look at their website, 1x.tech. Still another very early stage industry, but you should expect to see these things in consumers' homes starting next year, along with businesses as well, especially in factories, manufacturing. But again, the robotics sector had a bit of a sharp pullback today, along with other hot themes in the market. Bit of hot money coming out here in every category, including the big chip makers and biotech, except for these stocks involved in vaccines, which is admittedly a little worrying. Hopefully this new virus coming out of China doesn't escalate, and we'll be paying attention to the price action in Moderna for clues of that. Otherwise, it'll really be wait and see mode until Wednesday, Nvidia's earnings, along with PCE inflation, which actually comes out on Friday. And if those two things comes in good, I don't see any reason why the market can't find a low. But as it stands, we may be indeed in for a bit of a volatile start to the week. Got the VIX one day at 18. Are we going to see another monster Monday gap down? And how much longer is this pattern going to hold for? Weakness at the start and the end of the weeks on all this headline risk. That's all for the daily market review this week. Thanks very much for sticking with Click Capital. And just keep in mind, there's more to life than trading. I recommend turning off the screens this weekend and getting a little fresh air, as we could be in for another spicy one next week. That's all for now, and I'll see you guys again come Monday night. Cheers.